This is James LaTrobe-Bateman explaining a market development model. The application is for a medical device attached to hospital beds. Let's say its purpose is to prevent nosocomial infections. The device consists of a piece of hardware and some frequently replaced consumables. We want to decide what type of business model to use. Our options are sell the consumables but give the hardware away, sell the hardware with a nominal charge for the consumables, rent the hardware with a nominal charge for the consumables. So let's take a look at our model's dashboard. Here we have the market, the beds, and the fraction that the device is relevant to. Here we have marketing promotion costs with the object of bringing the device to the attention of as many buyers as possible. And here we have the reasons to buy the product. Efficacy. How well does it work? If that was 1, that would mean it worked perfectly. And there are other reasons to buy, of course, as well, which we input here. There are cost reasons, and these are programmed internally into the model. This gives rise to a probability that the customer will buy, which when combined with the awareness generated by marketing gives a market share and hence the number of beds equipped in each year. Here we have the prices set, consumables and hardware, and here we have the price set for hardware rental with consumption rates and hardware lifetime here. On the left we have the cost of goods for the consumables and the hardware, and from all of this we calculate revenue, expense and profit, and a couple of other financial measures. So this is looking at year 1. As you can see, for year 1 we have a market share of 2.2%, which would equip 1,400 beds, and with all of those other inputs that would give you a loss of $1.4 million in the first year. If we go forward to year 2, the number of beds equipped goes up to 14,000. We're still not making a profit though. Go to year 3, now we're into profit, we've got 19,000 beds equipped, and so on. So if you plot all those, we can look at the cash flows by month, which look like this. Below the line in red are the expenses, above the line in green are the revenues. The bar up here indicates the break-even point. Cumulative cash flow, otherwise known as the hockey stick, looks like this. We can also produce profit and loss accounts and balance sheets and overall profit figures by year, which for this scenario starts off the 2 negative figures as we mentioned, then it goes into positive as the years go by, leveling off as the market becomes saturated. So the question is, how sensitive is this model to some of the assumptions? For that we have this sensitivity analysis. Down here we have the various variables, some of them shown on the dashboard, some of them built internally, and here we have some colors indicating whether that is a risk or not. If the present value declines when that variable gets less, this will show red. If it increases, it will show green. And if it decreases a little bit, it'll show yellow. So red is a risk, green is an opportunity, and yellow is a slight risk. So let's just see how it looks for the scenario we've got here. Just run the macro, and as you can see, it goes through each one in turn and it gives us the appropriate colors. For this one, we have a number of colors. Top of the list is efficacy. As you might expect, the product has to work or we don't make money. If it works better than we expect, then it'll make more money. We've got 4 red-green pairs like this in this scenario, but we also have one here that's a little bit odd. Under consumable price, we have 2 reds. That means if consumable prices were too low, we don't make enough revenue, but if they were too high, we frighten off too many customers because the cost of the system is too expensive. This is not a good position to be in. It's a kind of cusp, if you like, where you really are walking a tightrope. We don't really want to be in that position because you'll never get that right. We've got a few other issues going on here as well. So let's just go back to what this scenario was. This is a scenario 1, as we mentioned earlier. This is where we set the consumable price to be where we make the money. We give away the hardware and we're not renting the hardware. As you can see here, we've got calculations of what the consumables would actually cost us, so you can see what the margin is there, and what the hardware costs us, so you can see what we're giving away there. Let's try the second scenario, which was to sell the hardware and more or less give away the consumables. And I'm going to put that back to year 1 just so you can see how that compares. If we look at the monthly cash flows, we've got a different picture It pays back much quicker. As you can see, we get a peak in revenues, and then it all falls back, as you might imagine, because we've equipped as many hospitals as we can. Then there's no more to equip except for just replacement costs. If we look at the hockey stick, we've got a very rapid growth up through the 0 mark within a year or so, but then it starts to tail off fairly soon too. If we look at the profit chart, you can see very early profits, then not so much, and then we have funny bumps here which are related to the replacements of the hardware as time goes by. Let's look at the sensitivities on that one. Reset this, run the macro, picture changes. It looks a lot cleaner, this one. There aren't so many things to worry about. We've got 1, 2, 3 red-green pairs. Efficacy is still top of the list. And we've got one here we might pay attention to. Efficacy coefficient. You might wonder what that is. Well, in the model we've built in a relationship between sales effectiveness and efficacy according to a function. It's a non-linear function, as you can see. There's a curve to it. So we need coefficients to define that curve. And this one back here is one such coefficient. Really don't know what that is. It's a guess, actually. So that's a risk, an opportunity. We can't really assess that easily. We do have a very slight risk associated with the hardware price. Again, if it was too cheap, we'd be not making enough revenue. If we charge too much, our customers are slightly put off. But that's a much cleaner picture than the one we had before. So let's look at the third option. This was to not charge up front for the hardware, but to charge for renting it. Let's say $5 a week, and run this through the model. This time we get a much more conventional cash flow picture, paying back within 2 or 3 years. Cash flows gradually grow, and then we saturate the market. The hockey stick looks like that, and the profits look like that. We start to make profits in year 2, then we stabilize as the market saturates by about year 6. If we look at the sensitivities, run the macro again, colors change, so different things matter. See things coming in there, something else down there. So we've got efficacy, again top of the list. The product must work. We have this efficacy coefficient again to some extent. Down on the bottom, I haven't mentioned this, the number of beds is important. We do need to understand the size of the market, of course. And then we have this risk, slight risk associated with the hardware rental price. If we make it too cheap, we're not making enough revenues. If we push it up too much, we put off customers. And there are a few other issues here to worry about as well. So we have quite a quick and easy way to assess these alternative plans using this model. There are some inputs on this dashboard, and there's some inputs built in. We can challenge all of those, but the whole purpose of this is to allow you to explore that territory so that you make your best business decision. That's what we mean by this market development model. Thank you for listening.